One phone call, one accident, one storm, one hospital bill, one lawsuit, one flooded house, one stolen car, one delayed shipment, one unexpected fire, and suddenly a company that looked unstoppable is facing millions of dollars in losses. And that is exactly why insurance companies exist, because behind every insurance policy is a giant system built around one powerful question. How likely is it that something will go wrong? And how expensive will it be if it does? Welcome to Careful Click, where we break down how the financial world really works. And today we are diving deep into one of the biggest hidden systems quietly controlling modern life, the insurance industry, because almost every person pays for insurance in some way, whether it is health insurance, car insurance, life insurance, travel insurance, business insurance, or home insurance. But very few people truly understand how insurance companies calculate risk, how they decide who pays more, who pays less, who gets approved, who gets rejected, and why two people living in the same city can receive completely different insurance prices for almost the same thing. And once you understand how risk is calculated, you begin to realize that insurance is not really about luck. It is about statistics, psychology, economics, human behavior, probability, and billions of pieces of data moving silently behind the scenes every single day. And the truth is, insurance companies are not gambling companies hoping for random outcomes. They are highly calculated financial businesses using mathematics and historical patterns to predict the future as accurately as possible, because their survival depends on one thing: collecting more money in premiums than they lose in claims. And if they fail to predict risk properly, they can lose billions of dollars very quickly, which is why insurance companies spend enormous amounts of money hiring actuaries, analysts, economists, engineers, fraud investigators, statisticians, medical experts, behavioral analysts, and even AI systems just to answer one question: how risky is this person, this business, this building, this driver, this neighborhood, or this situation? Now, imagine two drivers applying for car insurance in America. Both own similar vehicles. Both are almost the same age. Both live in the same state. But one driver pays almost double the price, and many people become angry when they see this difference because they think insurance pricing is random or unfair. But insurance companies are looking at hundreds of hidden variables most people never notice, including driving history, accident frequency in that zip code, average repair costs in that region, theft statistics, nighttime driving behavior, traffic patterns, credit history in some states, vehicle model risk levels, weather conditions, lawsuit history, and even how often similar people file claims in the future based on past data, because insurance companies are not pricing only the present moment. They are pricing what they believe could happen months or years from now. And one of the biggest secrets about insurance is that insurance companies do not actually need to know exactly what will happen to one individual person. Instead, they rely on the law of large numbers, meaning that when millions of people are grouped together, patterns become predictable, because while nobody can predict exactly which specific house will burn down next month, insurance companies can often estimate approximately how many houses out of 1 million are statistically likely to experience fires during a year. And this predictability is what allows the entire insurance industry to function, because insurance is really a system of shared risk spread across large populations. This is why younger drivers often pay more for car insurance, because statistically younger drivers are involved in more accidents, especially high-speed accidents. And insurance companies do not personally know whether a specific young driver is responsible or reckless. They are simply using historical probability. And many people dislike this reality because it feels personal. But insurance companies are operating based on large-scale risk calculations rather than emotions. And the same system applies to health insurance, where smoking history, chronic illnesses, obesity rates, exercise habits, Family medical history, age, and even occupation can influence pricing because insurers are trying to estimate future medical costs before they happen. And this becomes even more fascinating when you realize that insurance companies are constantly updating their models using new information from the real world, because risk itself changes over time. For example, climate change has dramatically changed insurance calculations in many parts of the world because hurricanes, floods, wildfires, and severe storms are becoming more expensive and more frequent in some regions, forcing insurers to completely recalculate property risk. And in some extreme cases, insurance companies have even stopped offering coverage in certain high-risk areas because the potential losses became too dangerous for the business model itself. At the same time, technology is transforming how risk is measured because modern insurance companies now use artificial intelligence, machine learning, satellite imaging, telematics devices, predictive analytics, and enormous databases to monitor patterns faster than ever before. And many drivers today unknowingly participate in real-time insurance tracking through apps or devices installed in vehicles that monitor braking behavior, acceleration, mileage, speed, nighttime driving, and road usage, because insurers discovered that actual driving behavior often predicts future accidents more accurately than traditional demographic assumptions alone. And this is where the psychology of insurance becomes extremely important, because insurance companies are not only studying accidents and disasters, they are also studying human behavior itself, because people behave differently when they feel protected, a phenomenon economists call moral hazard, meaning that some individuals take greater risks when they know insurance may cover the consequences. And this is one reason deductibles exist, because insurers want policyholders to still feel financially responsible for smaller losses, so they remain cautious and avoid unnecessary claims or reckless behavior. Now, if you are enjoying this deep breakdown into how the financial world really works, take a moment to subscribe to Careful Click. Give this video a thumbs up, leave a comment telling us which part of the insurance system surprised you the most, and share this video with someone who pays insurance every month without fully understanding where that money goes. Because once you understand these systems, you start making smarter financial decisions in everyday life. And one thing many people never realize is that fraud plays a massive role in insurance pricing, because every year insurance companies lose billions of dollars to fraudulent claims, fake injuries, staged accidents, exaggerated damages, false medical reports, and organized criminal networks. And those losses eventually affect everyone else through higher premiums, which is why insurers invest heavily in fraud detection systems, investigators, surveillance tools, behavioral analysis, and AI-driven anomaly detection systems that search for suspicious claim patterns hidden inside millions of transactions. And the economics behind insurance become even more powerful when you understand that insurance companies themselves also buy insurance, a process called reinsurance, because large disasters can create losses so enormous that even giant insurance companies cannot safely absorb all the damage alone. So insurers transfer portions of their risk to even larger global financial firms known as reinsurers, creating a giant worldwide network where risk is constantly divided, transferred, priced, and redistributed across countries and financial markets. And this hidden system quietly stabilizes economies after disasters by preventing single companies from collapsing under catastrophic losses. For example, when a massive hurricane hits part of the United States, causing billions of dollars in property destruction, the financial burden is often shared across multiple layers of insurers and reinsurers around the world, which means insurance is deeply connected to global finance, investment markets, banking systems, government regulations, construction industries, healthcare systems, transportation systems, and even political decisions, because whenever risk changes in society, insurance calculations change too. And one of the most controversial areas in modern insurance is the use of data itself, because many consumers worry about how much personal information companies collect in order to estimate risk more accurately, and different countries have different rules controlling what insurance companies are allowed to use. Because while some regions allow the use of credit scores, driving behavior apps, or detailed consumer data, other regions restrict these practices due to privacy concerns and fairness debates. And this creates an ongoing global discussion about how much prediction is acceptable before risk calculation begins to feel invasive or discriminatory. Meanwhile, businesses depend heavily on insurance to survive because companies face enormous financial risks every day, including lawsuits, cyber attacks, employee injuries, equipment failures, supply chain disruptions, natural disasters, data breaches, theft, and operational shutdowns. And without insurance, many businesses would collapse after a single major incident, which is why risk management has become one of the most important hidden industries powering the modern economy. And perhaps one of the most interesting truths about insurance is that the safest customers are often the most profitable customers, because people who rarely file claims may continue paying premiums for years without needing large payouts. And this steady stream of collected premiums allows insurers to invest billions of dollars into stocks, bonds, real estate, government securities, and financial markets, meaning insurance companies are not only risk businesses, they are also enormous investment institutions quietly managing vast pools of money around the world. This is why interest rates matter so much to insurance companies, because when interest rates are high, insurers can often earn more investment income from the money they collect, while lower interest rates can pressure profitability and force pricing adjustments. And suddenly you begin to see that insurance pricing is connected not only to accidents and disasters, but also to inflation, central bank policy, healthcare costs, repair costs, labor shortages, legal systems, and the overall economy itself. And then there is the emotional side of insurance, because fear drives much of the industry. Fear of losing a home, fear of medical emergencies, fear of lawsuits, fear of accidents, fear of uncertainty. And insurance companies understand this deeply because their business exists to convert uncertainty into predictable monthly payments. And while many people complain about premiums, most people also feel relief knowing they have some form of protection standing between them and financial disaster. But the system is not perfect, because disputes happen constantly over denied claims, policy wording, exclusions, loopholes, deductibles, valuation disagreements, and legal interpretations. And many consumers discover too late that they never fully understood what their policies actually covered, which is why financial education matters so much, because understanding risk before disaster happens can protect people from devastating surprises later. And in the future, insurance may change even more dramatically because artificial intelligence, autonomous vehicles, climate forecasting, wearable health technology, smart homes, biometric tracking, and predictive analytics are creating entirely new ways to calculate human behavior and future losses, meaning the insurance industry of tomorrow may become even more personalized, more data-driven, and more predictive than ever before, raising major questions about privacy, fairness, accessibility, and the future relationship between technology and financial protection. So the next time you see an insurance payment leave your account, remember that behind that simple transaction exists one of the most sophisticated financial prediction systems ever created, a system built on mathematics, economics, psychology, probability, technology, and human behavior, all working together to answer one timeless question: what could go wrong next, and how much will it cost if it does? And if you enjoyed this documentary-style breakdown, subscribe to Careful Click, give this video a like, drop a comment below, share this video with friends or family interested in finance and economics, and stay tuned for more deep financial explanations designed to help you understand how the hidden systems around you really work. Warning disclaimer: this video is strictly for educational and informational purposes only. We are not financial advisors, insurance agents, or legal professionals. Always do your own research and consult qualified experts before making financial or insurance decisions. Careful Click does not support illegal activities, fraud, or harmful behavior of any kind. Stay informed, stay smart, and always click carefully.